Okay.
Thank you very much. This is the blockchain course, History, Categorization and Use Cases. I am Donald McIntyre, founder of Etherplan. I am also an Ethereum Classic volunteer. And for work, I am Director of Business Development at BIwares, a data science firm. Last Monday, we did the first part of the course. We talked about the cypherpunks, the first attempts and projects to create money on the internet in the 90s and early 2000s. Then Satoshi Nakamoto and his creation of Bitcoin, Vitalik Buterin and Ethereum, which added smart contracts, which was one of the major goals of cypherpunks since the 90s. Consensus systems, the comparison between proof of work, proof of stake, and proof of authority. And then we saw what happened during the split between Ethereum Classic and Ethereum. And we reviewed what is the general proof of work security model. No, that we define that these networks are not trustless, but trust minimized, because there's always a small margin of trust still left in node operators, miners, developers, and the ecosystem at large. Today we're going to see the part 2, which is categorization and use cases. It's going to be more or less 2 hours, depending on how many questions there are. And we're going to talk about types of cryptocurrencies, listings, explorers, exchanges, then the use cases, savings, investment, and reserves for families, institutions, and governments, the layers of the blockchain industry, the components of the blockchain industry, how it's going to evolve in layers and components, very likely. And then we're going to see specific cases of things that everybody talks about and everybody's doing in the present day, like NFTs, how ownership records are going to be in the blockchain, DAOs, what is a DAO, contracts between people and businesses, and businesses, gaming and the metaverse. I'm going to give my opinion of what I see is going to happen there, how to build a crypto app, or to integrate crypto into an existing app. This is useful for people who already own businesses and they want to integrate crypto into their existing apps, for example. And the last part is how data science and the blockchain are going to work together in the future. And this includes artificial intelligence, machine learning, etc. So this is what we saw in the first part of the course. And we're going to start the second part. The first thing that I want to do is to go over this, which is very important in this second part. It is going to be like a theme in some parts of this second part of the course. So everything started when the public key cryptography system was created, no? And today blockchains use that as one of the core components, because people have the private key and they have their public keys. And with the private key, which must be secret and held with high security by the owners, they control the public key, which is known by everybody, and it's transparent in the blockchain. So the public key is basically your account inside a blockchain. The secret key is associated to the public key through a mathematical function. And blockchains have different formats of how to show the public key. In the case of Bitcoin, they look like this because they use a special way of changing the public key, which is the same number, but expressed in another base, in base 58, with a special format for Bitcoin. And then Ethereum accounts and all the EVM blockchains, they use this format. Basically, it's the public key with a 0 and an X. But the important thing is that the blockchain pushes the responsibility of control and ownership of anything that one has inside a blockchain to the individual. No, we don't, because we want to minimize or eliminate trusted third parties like banks. We don't have our things in a banking institution, and the banking institution is responsible for the custody. In blockchains, we are responsible for custody. And nevertheless, there are different models where this is handled. That there's different models of services like exchanges and wallets that use this in different ways, and sometimes they're centralized. And the critical part to understand is that if you have the private key, then you control everything. If you delegate this to somebody else, like a service or an institution, then somebody else controls your stuff, just like the traditional world. So I just wanted to go over that again. So yes, I also wanted to go over the fact that proof of work um, blockchains, they use Nakamoto consensus, which was explained in the first part of the course, and is more secure but less scalable than the other consensus mechanisms. Proof of stake uses deposits in the network to secure the blockchain, so it throws away the security of proof of work. And this means that it's less secure, but the trade-off is that they're more scalable. You can transact billions of transactions in proof of stake blockchains. Proof of authority is they use trusted operators. They don't even use stake, so it's even even greater reversal of the security of proof of work, because they're practically like the banking system. They are scalable, but even less secure for these reasons. Okay, so what are the types of cryptocurrencies? Useful categorizations for cryptocurrencies first is to group the ones that are native and not programmable. What does native currency mean? When you have a blockchain like Bitcoin or Ethereum 1 or Ethereum Classic, the native currency that is created to pay for blocks to miners and is used to pay for transaction fees, that is the native currency. It's the one that is a core component of the blockchain itself and how it works. Within that category, you have the ones that are not programmable. For example, Bitcoin, Litecoin, Dogecoin, Bitcoin Cash. All those are not programmable. Then you have native currencies that are programmable, like Ethereum 1 and Ethereum Classic, because they are the currencies that are used to pay for blocks and to pay for fees. And at the same time, those networks support smart contracts, so you can program the movement of money inside the blockchain. In these programmable blockchains like Ethereum and Ethereum Classic, and the proof of stake ones like Solana and EOS and Tezos and Polkadot, Cardano, etc., because you can create apps. One type of app is called ERC20, which are used to create what I call non-native currencies that are created with smart contracts on programmable blockchains. This is, you can send a program that says, okay, this program is going to manage a new coin that is called, say, Donald coin, and I'm going to issue 10 million, and I'm going to give it to people under certain conditions. So I issue a currency. Well, this currency is a cryptocurrency. There's thousands of these created on BNB and Ethereum Classic and Ethereum 1 and other places. they are currencies, they're tokens, just like Bitcoin and Ethereum, Ether or ETC, but they're not the native token of the network. This is very important because it's a significant, I would say, economic and security difference between ERC20 tokens, which are fungible and are cryptocurrencies, but they're not the native currency, so they don't have any purpose inside the blockchain. Bitcoin, Ethereum, and ETC, they have a purpose because they were actually created to pay for the security of the network, the proof of work mining, and they pay for the hash power that protects the network, and they also pay for transactions to be included in blocks. So they have a fundamental economic role. ERC20 tokens don't have any role. For example, Shiba, if you compare, everybody in the industry, or noobs and people that don't know, or new investors, they think that Shiba and Doge are both funny meme coins and that they're the same, but they're not the same. Doge actually powers and it's a key component of the economy of the Doge ecosystem, because of the reasons I said before. But Shiba is just an ERC20 token in Ethereum with no purpose other than that many people know it, and they're using it and they trade it, etc. So there's a difference between ERC20 tokens and the native coins. That doesn't mean that an ERC20 token cannot be most successful. If you have sufficient marketing and people use it, well, that's a use case in itself. Also, some ERC20 tokens are used actually to do something. So, for example, in Uniswap, which is an exchange, as a dApp in Ethereum one, the token is used to vote for future changes. So it gives some role to the token. Then you have most other dApps, tokens created by a program inside programmable blockchains, which are the stable coins. And the stable coins can be separated in two types. One is what I call the convertible stable coins, like Tether, and which is the symbol is USDT, and you have USDC and others that are issued by exchanges, etc. Those are pegged one-to-one to a currency. For example, in the case of Tether, it has like 75 billion or $80 billion in bank accounts, in real banks, in the traditional world, and they issued 75 billion or 80 billion Tether on the blockchain. They issued them in several blockchains. I think Ethereum One, Tron, and others. I don't know. I think it must be also in BNB. So they have each token is always worth one inside blockchains, because people have the option of returning the token to the issuer, and the issuer is going to send the dollars in the banking system, in the traditional banking system, through a wire transfer, for example. So they maintain the peg in that way. If you want to issue more, you send these people who are Bitfinex, based in Singapore, you send them $1 million, for example, and you tell them to issue 1 million USDT in your account in Ethereum One. And if you want the money back, you just send them back the tokens, and they send you back your $1 million. So that's how it works. And this is why they maintain the peg. Then you have guaranteed stable coins like DAI, for example, or Terra Luna. Terra Luna is a blockchain, but they have stable coins inside that are guaranteed in this way. And instead of being guaranteed on a one-to-one basis with a currency like a dollar, one-to-one, the token is worth $1 because it's $1 that guarantees it outside of the blockchain. These are guaranteed by other cryptocurrencies. So in the case of DAI, people send, it's very complex, but in general terms, people send crypto somewhere, and they receive a token, that I think is called Maker. And against that cryptocurrency that you sent them, they issue a portion of it, say 50% of its value, they issue DAI. And that DAI is guaranteed by Bitcoin, Ether, I don't know, cryptocurrencies in general. And it keeps the one-to-one relationship to the dollar because they have this guarantee that is over guaranteed, that is always going to pay if somebody wants to get out of the DAI at the at the parity of one-to-one with the dollar. So it's a different way of guaranteeing it. Instead of guaranteeing it with like €1, $1, it's guaranteed with something else. So these are the two types of stable coins. These are not native currencies. They are just smart contracts that issue these coins. I think they're also ERC20 contracts. Then you have privacy coins like Monero and Zcash, for example, and Mimblewimble. These are different model than normal blockchains because one of the key features of blockchains or important features of blockchains like Bitcoin, Ethereum 1, Ethereum Classic is that they're transparent. Anybody can go and see the accounts, the smart contracts, audit the chains, check the supply, check if the blocks are being well formed, etc. So they're very, very transparent in that sense. But the downside is that everybody can see your accounts. No, if for some reason somebody can know which is your account there, they can trace your account. So they don't have much privacy. They're transparent, but they don't have privacy. Privacy coins, what they do is they encrypt all the information. Some in one way or the other. Once they do mixing, some they do mixing, others do direct encryption like Zcash. And Mimblewimble uses a special system that also hides the information. I don't know if one would call it encryption. Maybe Firo could answer that. But they hide the information so people cannot understand what's going on inside the blockchain. Therefore, the accounts are hidden, and the balances and the transactions, and therefore they're more private. I think that the trade-off here is that they're more difficult to audit. For example, I don't know if Mimblewimble, there's a way of knowing if there was a bug in the software and if they're issuing the right amount of coins per block, or the supply is correct, or stuff like that. You cannot audit it. Then you have other types of crypto which are also not native, non-native. There are the ones issued by decentralized finance, dApps. They call them DeFi. This is the example of Uniswap. There are applications on programmable blockchains that allow stable currencies, for example, which is one kind of DeFi app, and exchanges, loans, deposits, insurance, investment funds, etc. All these decentralized DeFi dApps, many have their own coins as well. So that's another category. And you have some rights. In some of them, you get dividends or passive income, as they call it. In others, you have that, and also you can vote. In others, you can just vote. And there's different kinds of cryptocurrencies, and they all trade in the market and are worth billions of dollars. And the last category that I always show in my course is this, the file storage coins, which I think are very useful, which are networks of machines that store files for the public in peer-to-peer networks, so they are decentralized. And these coins pay for those machines to store those files. So it's a much more secure way than storing your file in a service like Dropbox or Google Drive or something like that. This is the function of file store. Also, file storage networks are going to enable what they call Web3, because today when we use dApps, we usually use centralized websites. But in the future, the code of those websites and the images and the CSS code and all that, HTML, PHP, etc., and JavaScript. I'm sure it's going to be um, in these file storage systems and migrate from cloud services to these places. So uh, not only the smart contracts inside blockchains are decentralized, but also the hosting of files, images, and the websites themselves are decentralized. Any questions about these types of cryptocurrencies?
Oh, sorry, I had a question.
Hmm.
So for the Tether coin, I noticed that you said there was like a small amount. Um,
Which
like is it
one?
like the for ERC 20, like a Tether coin, like USD Tether?
Yes.
So if there's like a small reserve and there was like similar to the Great Depression, like a run on the bank, what would happen
Hmm.
if everyone tries to convert all their crypto to cash at the same time?
Well, in theory, with the business model of Tether, of the company that manages USDT, that's the one that you're asking, no?
Yes.
What they have is $80 billion in banks, so they earn interest there, and they're not paying that interest to the owners of USDT. USDT is just a token that is worth 1 to 1 to the dollar. So their business model is to have the custody of the real dollars in the traditional world, and they must do something with those dollars, and they buy commercial paper. I've read that, and treasury bills, all things that are very low risk, but they earn some interest, no? And it must be from, I don't know, 0.1% to 1%, depending on what they buy. But if suddenly everybody wants to transform the $80 billion because there's a run, and they have to return the $80 billion in one day, I'm sure they're not going to have the liquidity because they would have to liquidate all their treasury bills and commercial paper and all that. So I think it does have that risk. The other risk is just that you're trusting a centralized entity for this token. No, there's $80 billion. It has a lot of velocity. It's used for a lot of volume of trading in the world of crypto, and everybody's trusting the same one single company, which is Bitfinex, and their subsidiary, which is the one that manages Tether. Um, so yes, it is. It's a very good example and very good question because it's an example of how the ERC20 token itself is trust minimized because it's inside a blockchain, but because a fundamental part of its service is connected to the real world, then it becomes totally uh, insecure, no? Because you're trusting a centralized entity.
Exactly. And then I had another question. So if that's the case, that means in theory, if there were a run on the bank, DAI would inversely increase in value.
Did you say die?
Yeah,
Die, bueno, die is a different model. Okay. What you're saying is what would happen in the market if people would move from USDT to DAI.
yeah, it just like inversely increase.
Yeah, bueno, I think that I don't know what would happen. Yeah, people I guess would migrate to other stable coins or directly buy Bitcoin, no? Because it's more secure than any stable coin.
Oh, true.
I don't know. I don't know what would happen. I don't know what's the how fast DAI can issue new coins if they have this kind of run um, in favor or against. But in general, in normal conditions, they all stay at one normally. I don't know what would happen if there's a run from USDT to DAI because I don't know very well how DAI works internally because it's very complex. I never spent the time to check it. Any other questions?
Just one.
Mm-hmm.
From the three stable coins that you have mentioned, USDT, um, DAI, and the other one, I think
Luna.
only I think only one is the most regulated, USDC.
USDT. When a USDT, I think that when a one half lives in the regulated world, no, in the traditional world. So yes, Bitfinex is regulated. They have to go through a whole process to exist, and the money is in regulated banks. Uh, but I think that the half that is inside the blockchain, the tokens themselves, the 80 billion tokens, I don't think there's regulation yet. I don't know if in Europe or somewhere in the world they have regulated it. Um, but for now, I think the guarantee is 1 to 1, $1, one USDT. I don't know if that was your question.
I was just saying that USDC is more regulated in United States.
Yes, USDC is I don't remember what was the name of the company, Coin Shares or something like that. Um, it's in the United States, yeah, but the other one is in Singapore. Singapore is also a strong jurisdiction in terms of regulation. It's used for offshore stuff as well, but it's a very most credible jurisdiction. But the other one is in America. I don't know, and USDC has the money, must have the money in American banks, but again, I don't know whether the ERC20 token that is inside the blockchain is regular. I think those guys they have like $30 billion or something like that issued. I don't know. I really don't know what's the situation in terms of regulation. But again, here we're talking about blockchain, the contrast of the blockchain security versus the traditional world security. So even if something is regulated, that doesn't mean that it's creditworthy. I mean, banks can be regulated and brokerage firms and exchanges, but that doesn't mean that they cannot go bankrupt or they cannot be corrupt or commit fraud, no? The security of the blockchain is different because it actually doesn't need regulation. Everything inside the blockchain is law, no? Code is law. So everything's going to work as programmed. It doesn't matter if they're regulated or not. We're going to talk about this later. Okay, I'm going to continue. So these are, bueno, the audience in this course, maybe you guys already know about crypto, so you know about these lists. But when I present it to companies and clients and multinationals, I go over these categorizations. No, the first big categorization I do of the blockchain industry is between proof of work coins and proof of stake coins. No, it's two different worlds, as we saw in the previous class. It's two totally different security models, and proof of work is more secure but less scalable, and proof of stake is less secure but more scalable. And this trade-off is going to be complementary. I'm going to show this um, later. Also, what I want to show here is that Ethereum 1 now is on the proof of work side, but it's going to migrate to proof of stake. And when it migrates, it's going to be clearly the biggest blockchain, um, smart contracts blockchain that is proof of stake. Today, it's BNB. I don't know why Messari doesn't list BNB or BNB Smart Chain, but BNB and Smart Chain are the biggest, and Solana is next. But Ethereum is going to cross to this side and is going to be the biggest. In the case of Ethereum Classic, it's going to automatically become the fifth largest proof of work blockchain in the world. And I think that because Dogecoin, Litecoin, and Bitcoin Cash are not programmable, and Ethereum Classic is, then Ethereum Classic is going to rise to be the second largest proof of work blockchain in the world. And it's already pretty close because Ethereum Classic is worth 4 billion and Bitcoin Cash is worth 6 billion. So it can, I think in the short term, it's going to surpass Bitcoin Cash at least, and it's going to be very close to Litecoin, so it can surpass Litecoin as well. So this is going to continue, and I think it's going to eventually be the second largest after Bitcoin. Then I do a more refined categorization, and I divide, okay, which are the pure coins, pure native coins. So this is not a division between proof of work or proof of stake or proof of authority. This is just what blockchains or networks are just a coin with accounts and balances, and that's it. Bueno, clearly, Bitcoin is one, because Bitcoin is only accounts and balances and movement of money, and that's it. XRP, which is proof of authority, and then Dogecoin, Litecoin, and all the rest. These in this list are all, digamos, single purpose blockchains. They only have accounts and balances. Then you have the programmable ones that support smart contracts, and here you have the big one, which is Ethereum. And then you have these. This is the one, Terra Luna, that I mentioned before. And you have Terra, Solana, Cardano, Avalanche, etc. Ethereum Classic in the programmable list of blockchains is number 14. It's number 6 in proof of work, like I showed in the previous slide. And in terms of smart contracts, it's number 14, but I think it's going to go up when it goes up to be the second largest proof of work blockchain. And then you have the list of stable coins. Tether, it's $80 billion. USDC, oh, it's $53 billion. The one that you mentioned, bro. And then you have Binance issue their own coin. This is the Terra one. And then DAI that we spoke about. And then you have all the rest, no? The Gemini dollar. I think it's good that we have many stable coins, so people can, instead of having one, like only Tether, they could have 5 or 10 of these. And they're all going to be worth one, so you can diversify. In fact, I thought at one time to create a new ERC20 token that is basically 10 of these. So you get 10 of these, you put them in a smart contract, and you issue 10 coins, which are always going to be worth 1 to 1. But if one of these fails, at least the other 9 are going to still be there. So it's a way of diversifying stable coins in a way. Okay, so then privacy coins, like I mentioned before, you have Monero that does mixing. Harmony, I don't know how they do it. Zcash, they encrypt the database, so it's secret. And then you have several more that are smaller. DeFi, cryptos, these are the ones that power or have some kind of function for the dApps that issued them. Uniswap, Aave, Maker, PancakeSwap. I think PancakeSwap works on BNB, and all these are all DeFi dApps that issued their own crypto. And finally, the file storage. You have one big one, which is Filecoin, that I think everybody's using. I think NFTs are here. So when you see many NFTs, they are actually stored on Filecoin, which I think is Filecoin plus IPFS. They work together. And Filecoin is used to pay the IPFS nodes. One thing that is important in this list is to note that economies of scale are impossible to avoid. Decentralization in terms of technology of the blockchains and security does not mean that economies of scale don't exist. And because of economies of scale and network effects, you have this effect, which is the big ones in each list tend to be very big, and then you have 2 or 3 more that are relevant, and then the rest are much smaller. And I think that in general, in each category, you're going to have 3 or 4 big players, and then the rest are going to be irrelevant in the future. They're going to lose value. In the programmable ones, you see how, I mean, Ethereum is 10 times bigger than the second one. And this pattern where you have very few at the top and the rest insignificant is going to determine, is going to shape the future of the blockchain industry that I'm going to talk about a little bit later. Then you have cryptocurrency lists. Again, this is for noobs. People here in this class today must know all of these. CoinMarketCap, Messari, CoinGecko, but these are not good because, in my opinion, because they don't do this kind of categorization. You cannot go and say, okay, which are proof of work, which are proof of stake. I think that the big cryptocurrency lists that have the prices and everything, you can go and click here and check everything about each cryptocurrency and the price and the charts, but they don't categorize them correctly, in my opinion. For example, you have here, they're all just a list of crypto, no matter how what is their category, and just by the market capitalization or something like that. But they don't distinguish that this is a stable coin, that this is a programmable blockchain, that this is just a native currency and that's it, that this is proof of authority, etc. So it's much better to see the industry like this, because you can identify value and opportunities much better than thinking that BNB is comparable to Bitcoin, for example. They're not comparable. Um, then you have the blockchain explorers. These are very important for me. I mean, in the traditional world, before the blockchain existed, before Bitcoin existed, if you wanted to send money from one point of the world to the other, you would give the instruction to your bank, and it would take 3, 4, 5 days or a week, and you had to pray and light candles and pray to the gods that the money got to the other side, because in that week or those 3 or 4 days you didn't know what was going on, because your bank just debited the money from your account and the other side didn't receive the money, and the money was somewhere, but you had this uncertainty because it's not transparent, no, because the banking system is not transparent. With block explorers, when you send money, for example, even from a centralized service to another centralized service, for example, from Coinbase to Binance, or from MetaMask to Coinbase or to Binance, immediately when you send a transaction, you can go to a blockchain explorer and check. This is the one that everybody uses for Bitcoin, for example. And you come and check, put the account, and you can check the transactions. This is something, a level of transparency that before didn't exist. I don't know if many of you are young and you don't remember the traditional banking system, and I mean, your consciousness is already with blockchains in the last 12 years. But this level of transparency and that block explorers give all this information is one of the great benefits of the blockchain industry. You have, this one is the one for Ethereum. The very biggest one is etherscan.io, and you have, like in any blockchain explorer, you can check all the statistics per block. You can check individual transactions. You can go and check smart contracts, the code. A lot of people use the block explorers actually to certify things inside the blockchain, like smart contracts or NFT contracts, to give more credibility. This is so transparent that it's a way also to give a sort of certification and credibility to your smart contract. Then you have the exchanges. If anybody wants to open an account, anybody that is outside of the United States, they can open an account in Binance. It's the largest in the world, has a lot of volume, and you can go there and trade. It's a centralized exchange. This is exactly here. You do not have your private keys. You just delegate the custody of your crypto to Binance, which is the traditional system as before. But at least you can trade. What I do is I use Coinbase, this one, and I buy ETC usually here. And when I buy it, then I move it to my Ledger wallet. So I'm not running the risk of custody in Coinbase, because it could be censored, it could be controlled by the government, it could be confiscated, etc. No, like any bank. Um, so that's one detail, and it's important to know that these are centralized. Bueno, use cases of the crypto industry or crypto in general. It's important to remember that
Sorry, Donald, I have a question. Another question.
yes,
So I saw that Ledger is having like a Coinbase ledger. I wasn't sure like if that's safe, if that's like still like still a safe cold storage if it's partnered with Coinbase.
yes, because bueno, there's a part. It's like a loop, no? You have fiat money you go to Coinbase, you open the account, you put the fiat money, you buy the crypto, and then you send it to Ledger. So the first part of the loop is, and then when you have it in your ledger, if you want to go back to fiat, you send it back to Coinbase, sell it, and then you have fiat back. So the first part of the loop is centralized. So the risk is there, but once you have it in your ledger, it's the same risk as any hardware wallet. It's your own responsibility of writing down the 24-word passphrase, and you assume the responsibility of your uh, of your custody, no? And I think that Ledger, once you are in Ledger, you can use the Ledger app to buy and sell.
Alright,
But the thing is that
yeah,
the transaction goes to Coinbase and comes back to Ledger. So as long as the custody is with your private key, is good. But while the money is in Coinbase, is not going to be with that level of security.
sorry. I mean to clarify my question better is I own a ledger,
Yeah,
and I wasn't sure if upgrading to the Coinbase ledger is safe.
I think it's the same. In terms of the ledger itself and how it's used, it's the same. Yeah, I don't think that there's any new risk there.
All right.
I'm sure that what they're doing is they're automating the your ability to trade on Coinbase. So you must trade in the app, in the Ledger app.
Oh, I see.
Um,
Oh, okay. That's
but the
perfect.
thing is that the transaction is going part of the transaction is going to be in the Coinbase service for a while, and then you're going to receive back the money in your ledger. So while it's out of your control, that's where the risk is.
Oh, I see. Yeah. Thank you.
But as long as you have the custody in your ledger, then it's as
Oh,
secure as a ledger. No, if you lose your passphrase and if you lose the ledger,
yeah. Sorry.
then
I just assumed the ledger would be centralized because the
no,
Coinbase
I
ledger.
don't think so. No.
Okay. Thank you.
No, the thing is that Coinbase knows and Binance they know that many of us are doing this. We trade there and then we immediately we move it out when they let us, no, after X confirmation. Um,
Yeah. True.
so I guess they want to say no, let's partner so everybody trades with me, and we automatically send you the crypto when people trade.
Yeah. I'm gonna upgrade to that. It's more convenient.
Yeah. Check the details that it works like we described. Okay, I do not think that Ledger is going to move to a centralized model. That's my opinion. Okay, talking about use cases, then the overarching use case, which was the goal since the 80s, is trust minimization. Okay, this is very important because it has to do with the principles. If you're doing crypto and it's not trust minimized, like for example Ripple, then it's not a blockchain. I wouldn't even consider Ripple or Stellar blockchains. And BNB, I think it's borderline not a blockchain because it has trusted node operators. Um, so trust minimization is very important. Separation of state and money when we can see in the world what's going on with inflation, how much money central banks and even the reserve currencies of the world, like the US dollar, the British pound, euro, they're all having inflation and they're printing money like crazy. And that's never going to end. So the separation of money and state is a great use case. And then finality, the fact that, for example, now we can see what's happening in Ukraine and Russia. Banks are closing. There's distortion in both economies. One is being bombed, and the other one is being boycotted by SWIFT and the banking systems of the world. And people are moving to crypto because when you move money there, it provides finality. No transaction once it's entered there, it's final, and your balances are controlled by you, etc. So this is a key goal, and for me, it's incredible that it's being proven live in front of our eyes in not only in the current war, but what happened in Afghanistan and in China when they prohibited Bitcoin, etc. Minimization, minimization of interference from governments and corporations. Um, People who live in Europe and the West or North America and Canada, they don't understand these things. Sometimes they see um, crypto as just okay, number go up. No, I buy Bitcoin, it goes up, and I make money. But they don't value these trust minimization features and benefits. Why? Because they haven't lived in these stressful places. For example, I'm from Argentina. Argentina today, my kids, they cannot buy dollars, for example, because there's capital controls, and they cannot move dollars outside of the country, and they cannot sell things and export things because when they get the dollars, they are forced to sell it to the government. And then we have know your customer and AML, digamos, restrictions that here in the United States, there's 70 million people that are not banked because of these restrictions and confiscations. No, in my country, for example, in Argentina, one day in 2001, the economy minister woke up and he said that he froze all the bank accounts of the nation, and all the ones that were in dollars, he forcefully transformed them into pesos, and then the peso was devalued, so we all lost our money. So this happens all the time. So this is a great use case for security. Security in general, because they are practically impossible to hack. Bitcoin, Ethereum Classic, etc. A hack is not a 51% attack, like we said in the previous class. Um, Blockchains can be attacked in 51% attack with hash power, but they're not actually hacked. It's not that they broke the cryptography or something like that. Then the other use cases for savings, investment, and reserves for families, institutions, and governments. I think that every family and every individual in the world should own crypto as an investment, especially Bitcoin, Ethereum Ethereum 2 when it comes, or Ethereum in general, and Ethereum Classic. I think that before we used to say something like, you invest whatever you can afford to lose. When I don't say that anymore. Whenever a friend tells me, should I invest in crypto and Bitcoin and Ethereum plan, I tell them you should put one half of your portfolio in crypto. Now I think it's the other way around. The risk is not to be on crypto in the future. Whoever goes into crypto late, they're going to lose the opportunity of their lifetime for wealth creation. So I think it's the other way around now. You have to put a lot of your savings and wealth into crypto, in my opinion. This is my personal opinion. And then payments, this is obvious. We can see it around the world, how payments is a critical service of Bitcoin. And then remittances. For example, El Salvador, 20% of their economy is remittances from the United States, and it was in dollars, and now it's rapidly migrating to Bitcoin because Bitcoin was declared the official currency, one of the two official currencies in the nation, legal tender. Then for settlements, this is important. In the current banking system, you have the core of the banking system today is the central bank in every country. Then in every country you have the banks, the regulated institutions that are the banks, and they keep our accounts and balances, and they process transactions and checks and provide loans and stuff like that. No, and then you have a third layer, which is the high velocity payment systems like Visa, Mastercard, PayPal, and all those systems, and they process high volumes. When every day when the high velocity layer, which is the third layer in the banking system, processes billions and billions of dollars in transactions per day, they send all those transactions to the banks. The banks net them out, and they move the money in big chunks between their accounts internally within the bank. And then when there's a big balance that they have to pay to another bank, they send that transaction to the core, to the central bank. For example, if at the end of the day, JP Morgan, after netting out all the transactions of the day, they have to send $150 billion to Wells Fargo. That transaction is not done in a check. They don't send a check to Wells Fargo. They both have accounts at the central bank with their reserves, and they move from JP Morgan $150 billion to the account of Wells Fargo. And that is done in what is called FedWire, which is the system that handles these large settlements. So in networks like Ethereum Classic and Bitcoin, because they're proof of work and they're not very scalable, I am sure that these big, large settlement transactions are going to occur. In fact, you see in Ethereum Classic and Bitcoin and even in Ethereum One, etc., that sometimes they're very big billion-dollar transactions being processed very frequently, and those are what we call settlements. Um, Contracts between individuals and companies, and between companies and companies. These are the famous smart contracts. And then you have value chain, supply chain companies. For example, if somebody needs to export, if somebody in Mexico buys a car and the company is in Germany, the whole supply chain is going to be on the blockchain. What's going to happen? The transaction is going to be entered in Mexico, purchasing the car. The car company in Germany is going to see that transaction, is going to move the car from their storage facility, and they're going to call the logistics company that is going to send the container. They're going to put the car in a container. The logistics company is going to see the transactions on the blockchain as well, and is going to automatically send the container to the car company. And then the container is going to go to a port, where the port is also going to see that transaction on the blockchain. It's going to be all transparent and automatic. And the shipping company is going to be there ready, because they saw all these activities, is ready to receive the container. And then the shipping company is going to move the container to Mexico in the port there, and then send the container to wherever the dealer is, and the car is going to be delivered, or to the home of the buyer. And all these transactions are going to flow in one direction. The product is going to flow, and all the logistics and the payments, as each step occurs, the payments are going to flow in crypto in the other direction. So this is the concept of supply chain, and provides a lot of efficiency, transparency, reduction of errors, mistakes, and stuff like that. Finally, I think that all securities, bonds, shares, derivatives, everything is going to be issued on the blockchain. Today, all stocks, bonds, and all these products, financial products, yeah, they're hosted and moved and transferred in the private servers of banks and settlement systems, etc. But everything is going to move to the blockchain very likely. And last but not least, the decentralized applications that we have spoken about, no? Uniswap and all the dApps that we know, NFTs, all these are the dApps, stable coins, etc. So this is the list of use cases. I don't know if anybody has a question about this. Okay, I'm going to continue moving. So we've advanced a lot, and now I'm going to talk about how the blockchain is going to look in the future, which I would say is already happening today. I think, like I described before, that the traditional banking system, you have the core, which is the central bank, and then you have a second layer, which is the regulated entities, which are the banks, and then you have a third layer, which is the high velocity services and payment systems like Visa and PayPal and all that. And you have other layers as well, but that's a simplification. But in the same way, I think that the blockchain industry is going to also be divided in layers, where the base layer, layer one, is going to be the high value blockchains, and they're going to be proof of work, because that's where the core security is. And I think that Bitcoin is going to be the big one. And because of the reasons that I said before, Ethereum Classic is going to be the second biggest one. And because it's programmable, it's going to have a lot of, digamos, value and use cases at the base layer, processing high value contracts and stuff like that. Then on top of these systems, you're going to have the proof of stake blockchains, which provide scalability, less security but scalability. And you're going to have proof of authority blockchains and sharding and channels and rollups and all that. All these technologies together are going to provide this high scalability, and they're going to compete or even be better than the current high velocity systems. However, these blockchains, because they're less secure, they're going to anchor their state and use the services of Bitcoin and Ethereum Classic for security and also for sound monetary policies. And once these guys they do this, I think these two layers together are going to provide the whole experience of the blockchain in a complete way. They're going to provide both security and scalability. I'm going to show in a couple of slides the components where this is going to be seen even more clearly. But I think that's how it's going to work. And on top of this, these two layers that are going to work together, you're going to have then the decentralized applications, decentralized exchanges, NFTs, stablecoins, etc. And the user interfaces are going to be our wallets like MetaMask and Trust Wallet, Hibi Wallet, etc. So this is going to be the layers of the blockchain industry, in my opinion, and I think that it's already happening. The great difference to what we, digamos, traditionally think of a blockchain is that today a blockchain like Uniswap and a dApp like Uniswap works only on Ethereum. And before we thought that we were going to have, no say, Lightning Network only on Bitcoin, and dApps only inside Ethereum or BNB or another one. No, I think that um, dApps are going to detach from specific blockchains, and they're going to be multi-blockchain systems, and they're going to use this format, and they're going to use the best component of each layer and each blockchain for that specific use case. So I think there's going to be a moment where we're going to have in this layer 3, we're going to have a dApp that is going to use one or two proof of stake systems for high volumes, and then settle everything in Ethereum Classic and Bitcoin, for example. So the dApp is going to be multi-blockchain, which is very different of how we used to think about these things. And here you have the wallets. You have from the centralized wallets and services. I'm going to show it later. This is the analogy that I always do of the layers with the internet. The internet, these layers that I showed in the previous slide, all together are going to provide the experience, the full experience of the blockchain. And they're going to be both secure and scalable. And that's how the internet works. The internet is also divided in layers. You can Google this and read this. This is from Wikipedia. And it has 7 layers and many components. So it has a physical layer, data link, network layer, all the way up to the application layer. So the analogy here is that all systems eventually are reorganized in layers. And in our case of the blockchain industry, 5 years ago, we thought that everything was going to be on Bitcoin and Ethereum, and that's it. Now we know that everything is being divided into layers and components. This is the same information as the layers, but I just put names to the components so we can see it more clearly. So now Ethereum Classic is here between these two and Monero, and I think it's going to jump to be here, the second largest one with Bitcoin. And I think in each layer you're going to have the big 3 or 4 big players, but the rest I don't think they're going to be very successful. So I think that the rest of the proof of work blockchains are going to lose value and be very small. Here in the second layer, you have more complexity because you have different kinds of systems. For example, Lightning Network for now works only on Bitcoin, but I think it's going to work on other blockchains as well. It's more or less it's called channels. It's more or less like proof of stake because each channel they have to put money in Bitcoin, and once they put the money in Bitcoin, they can process transactions here, billions of transactions per day, and then every now and then they can go and settle in a big transaction in Bitcoin. So it reduces the cost of using Bitcoin, and also it relieves Bitcoin from the high volume, no, and the scalability problem. Um, then you have also these work on Bitcoin. They provide programmability to Bitcoin, RSK and Liquid. They are just smart contract blockchains. They have different models for consensus, and they use Bitcoin as their currency. So here you see how the industry is already organizing itself in layers. I would say that Ethereum Ethereum is already a layer 2 of Bitcoin, because there's like $15 billion of Bitcoin inside Ethereum in the form of an ERC20 token, which is WBTC. The Bitcoins are physically here, but they're traded here in high volumes. And for example, there's 1 million ETC inside the smart chain of BNB. So the smart chain of BNB is already a layer 2 of ETC. And Patient Money is building a dApp that is going to be up here that is going to use BNB and Ethereum Classic. So that's going to be amazing when he finishes that dApp. It's called Classic Rewards. The thing here is that I think Ethereum 2 is going to be the big one, and then BNB, it appears that is doing very well, and it's number 2. And then you're going to have Solana, Cardano, Polkadot, one or two of those that are also going to be big, but then the rest, I think they're going to lose. They're shit coins that are going to lose value because because of network effects as users, investors, and developers who build dApps, and people who build hardware for these systems, etc. We all need to focalize on few networks, and it's very difficult to create a dApp for 35 blockchains, for example. You're going to create a dApp for 2 or 3 blockchains or 4 blockchains at most, but to be maintaining, it's more or less like what happens in the with Windows and Mac, in the PC industry. If you're a developer, you're going to build at most for Windows and Mac because you cannot build for 30 operating systems, especially because nobody uses them. And the same thing with smartphones. No, people build usually for Android and for iOS, but people don't build for 30 different kinds of operating systems of smartphones. And the same thing with enterprise now with Linux, etc. So I think that we're going to have 3 or 4 big ones, and the rest are going to be very small. And then on top, we're going to have all the dApps that are going to work on those winners. Bueno, this layer is very important, and this has to do with what I said at the beginning, which is it's so important to control your private key. Here we spoke about Ledger, for example, and Trezor are the hardware wallets. These are the most extreme security that we can achieve today. Basically, when you get one of these little machines, they are like a pen drive, and the private keys are encrypted inside that pen drive, and they are encrypted, so they are secure, and they never touch the internet. And so your private keys are not in your computer or your phone that you can lose or somebody can hack and steal your keys, because they are usually connected to Wi-Fi, stuff like that. When these hardware wallets are totally disconnected from the internet, and when you use your computer to send a transaction, you only connect your Ledger wallet to sign the transaction, but the private key never touches your computer. So it's preserved in the pen drive, in the Ledger, in the hardware piece. If you lose it, bueno, there's a process with passphrases, where you can write down 24 words and you write them on paper, so that it doesn't touch. It's not in any device or anything, and you put it in a secure place. So if you lose your Ledger wallet, when you go buy another one, you enter the 24-word passphrase, and the secret keys are reconstructed again with an algorithm. So this is interesting because in the end we're going back to the Stone Age, writing things on paper. But that's a very interesting way, because in the end, full security is a combination of the physical world and the digital world. Bueno, and then you have, going in this direction, you have less security. MetaMask and Trust Wallet are secure. You write your 12 words, etc. But the keys are actually inside the phone and inside your computer when you use these. So it is possible that somebody can steal your computer. They figure out your password, and they start using your MetaMask, for example. So it's very secure, but it's a little bit less secure than the ledger. I would say significantly less, not a little bit less. And then you have these services, which are websites, My Ether Wallet and My Crypto, where you go, you construct the transaction there, and then you enter the private key in some way or another. You can just copy paste it, which is very secure, or you can use your ledger connected to My Ether Wallet and process the transaction. So it's less security and less security in this direction. Then you have Cash App, PayPal, etc., that are totally, and blockchain.com, which are totally centralized wallets. And then in the extreme, you have Binance and Coinbase that are totally centralized as well, and they have your custody, just like these guys. So if these guys are hacked or they steal your money, you're done. Any questions about the layers of the blockchain industry, the future, how it's going to evolve, and the components?
Just one question. Where do you see coins for file storage in this layer?
I think that I would consider they are not an app, and they're not a wallet. So I would consider them that they would be here. In this case, it's not a category that competes for scalability, stuff like that. They're just a new kind of service. So it's a good question. I think they would be here in another box here, like storage, but they're going to be very important. So Filecoin could be worth billions in the future, because so many people are going to use for Web3, Um, so I think there would be in layer two, like a special kind of service in layer two. The same thing with Chainlink, oracles, and all those services that I didn't put here, because I was more focused in the concept of proof of work versus proof of stake. But because all those services are proof of stake normally, then I would put them here as complementary services to the proof of stake services, proof of stake blockchains. Did I answer?
Yes, yes. I was thinking because I saw the OSI model. I was
Hmm.
thinking, where does storage fit in this crypto space?
Yeah.
And I also have a problem finding out, because it brings a lot of securities for data in a way that it hasn't happened before, only
Yeah.
by centralized systems like Microsoft, Apple, and
Hmm. Yeah. I think that in this layer, this is a simplification, because I only listed here the scalability, the systems that provide scalability and smart contracts, and that's it. But here you're also going to have the complementary services like oracles and file storage and other complementary services. So it's even more complex than this. Here I show the same slide as the previous slide, but as a comparison to the banking system. This is a typical banking system. In this case, it's the banking system of Mexico, but the US is the same. Argentina, Brazil, Canada, Europe, they're all the same. They all have the same components. You have You have the public in general that they use these high velocity aggregators and systems to connect to their financial institutions. And the financial institutions process and use a series of services like check processing services and stuff like that to process transactions and execute their services. And at the bottom, they use the central bank to settle everything. And the brokerage firms, they use the security settlement systems like DTCC and others to settle securities and bonds and all that. And there's so you can see how this is something done by a consultant in the banking industry, and he had this slide, and I just use it. But how similar the analogy is to how the blockchain industry is also going to be divided into components. Bueno, I finalized this section, no, not the course. We still have 40 minutes, I think. But this section of the future of the blockchain industry in layers and components to debunk some myths and see what is the reality. Maybe, bro, you have a different opinion now that you mentioned Filecoin. But there's one myth, and that we promoted this myth when I started in the Ethereum community in 2014. All the computing in the world is going to migrate to the blockchain. We thought that everything was going to be in Ethereum. And no one will control blockchain. They're impossible to control. That's another typical myth, which is the myth of trust less versus trust minimization. The reality is, to be frank and to be objective, is only computing that needs the benefits of decentralization will migrate to the blockchain, especially layer 1 and layer 2. Smart contracts, uh, digamos, the whole app is not going to be inside Ethereum. It's not only going to be divided into different blockchains, but also only the logic that needs security and decentralization is going to be in Ethereum Classic and Ethereum 2 and those systems. But the rest is going to be outside of the blockchain in higher layers, Web3, and maybe even centralized websites and stuff like that, depending on what is the need. Only the logic that needs to be secure is going to be, because it's very expensive. Blockchains are not, it's not that they can store all the data in the world, and it's not that they can, transactions are free. You have to pay for the transactions. Even if proof of stake is going to have low fees, but you still have to pay. So it's not going to be feasible to have to throw everything inside the blockchain. Anything that requires huge amounts of data or computing power, that's another thing. Blockchains don't have huge computing power. Will remain on private servers. Everything that requires secrecy or privacy, like intellectual property or secret formulas of the pharmaceutical industry and stuff like that, will remain in private servers. Not only that, much of that is going to be on paper. And the analogy is that the 12 words for the MetaMask and the 24 words for the hardware wallet, we actually write them on paper. So it's not that we can throw all our data into the blockchains, also for a reason of secrecy and security. And here I give the example: private keys and seed phrases, we have to write them in paper or keep them in systems that are separated even from the internet. Everything that is external to the blockchain can be controlled. What do I mean by this? There was a debate at some point, especially 2016, when Ethereum was reversing the blockchain, and I was debating with Vitalik and Vladimir Zamfir. And one of the things that they were saying all the time is, no. We have to be able to reverse things inside a blockchain. Imagine if there's something catastrophic going to happen, that there's a smart contract controlling, I don't know, a nuclear weapon. We should be able to control it. And what I always told them is, no, even if there's a dApp that is dangerous, that controls a nuclear weapon, and the logic is inside the blockchain, the nuclear weapon itself is outside of the blockchain. You have to control the systems from the blockchain to the nuclear weapon. You don't have to cancel the immutability of a blockchain. just because, and reverse whatever you want, just because you think that there's going to be an extreme case where the world is going to be annihilated by a nuclear weapon or something like that. And this was the analogy, the same analogy that I told them when I told them, you don't have to reverse the chain for the DAO hack. You just have to go to the FBI and the legal system and try to find the guy and get the money in that way, get the private key and recover the money. But you shouldn't reverse the chain. But the reality is that the external world is going to be exactly the same as before, and you can control it, and you can have security measures and all that. So this thing that no one will control them is partially a myth. Another thing is that we actually do upgrades, so there is some social level control of blockchains. We do changes. The thing is that when they are not, when everybody agrees, when something that is not controversial, they're easy to make, like an upgrade. But it's something when there's something that is controversial, that's when it's impossible to do it because the social layer is not going to accept it. For example, change the monetary policy of Bitcoin or something like that. So these are some things that I like to clarify about myths and reality about the blockchain. Before we go to NFT, anybody has any comments or opinions or questions? Okay, so let's go. We have 40 more minutes and we're gonna go through the cases. What are NFTs? Bueno, an NFT is a type of smart contract. It's the ERC 721, which is called non-fungible token standard, NFT. So it's basically a smart contract inside the blockchain that is unique. That's why it's not fungible. And it's unique in the world and the universe, and there's nothing else that is interchangeable, exchangeable with it. It's just a unique object. And this unique object inside the blockchain can be attached to objects outside of the blockchain. Like, for example, uh, digital objects or physical objects. For example, a car is an example of a physical object that is going to be attached to an NFT in the future. Today, what we know the most is what are called NFTs, which are digital images and art, but they're really digital files, and the metadata of those files are inside the NFT. So that's why the NFT serves as the way of making this object a unique object and scarce in the world. Um, so that's how it works in terms of the contract. Instead of being an ERC20 standard, an ERC20 standard, basically you issue not one unit, but millions of units if you want. And they're interchangeable between themselves, so they're fungible. In this case, they're not fungible, they're unique. You issue one unit and that's it, it's unique. They can be associated with any other physical or digital objects through metadata. Like I said, I think cars, real estate, homes, apartments, hotel rooms are going to be NFTs in the future. Containers, ships. They are transferable. So if you have an NFT associated with your account, with your secret key, you can transfer it to another account. So this means that they can be bought and sold in markets. The blockchain serves as the property registry itself. So because I have an account on the blockchain, I can not only have a balance of ETC, but I can also have an NFT associated with my account. So the property registry itself are the accounts themselves. And the NFT is just an object that is moved from account to account. So they leverage the blockchain as the property registry. And NFTs can be used not only for collectibles, which is what we're doing, that art, but also for intellectual property like music, movies. I think that Spotify is going to be a decentralized DApp in the future, and the file is going to be in Filecoin, and the music property rights is going to be an NFT inside the blockchain, and every time somebody pings the NFT and they listen to the recording, the NFT is going to collect some money and then send it to the owners, no, the artists, the writers of the music, the record label, etc. And the same with movable property, no, like cars, trucks, ships, real estate like land, farms, ranches, apartments, hotel rooms are going to be NFTs, in my opinion. All kinds of in general, then all kinds of registerable goods. And then cash flows, for example, is very common in the financial services that you have an invoice, you sold something, and that they're going to pay you in 90 days, and you go to the bank with the invoice and endorse the invoice to the bank, and they discount the invoice and they pay you, they give you a loan for that future payment that you're going to receive. So I think because these are non-fungible, because they're all different and they have they're not like bonds that are securitized. So I think they're going to be represented as NFTs. And then contracts, I think that many times when companies have contracts between companies or with other parties, sometimes they sell the contract because they don't want to be in that contract anymore. So I think that some contracts are going to be attached to NFTs or are going to be represented as NFTs to be able to be transferable. And then container, ships, goods, objects, supply chain in general. So this is why I say, and I even made a video that I say that to bring NFT to ETC is critical infrastructure, because many things are going to be enabled with NFT technology. Not only the collectibles that we're buying, and they're amazing, and all the activity that is there is great, because it's like a prelude and a practice for when NFTs are used in ETC for high value use cases. Bueno, NFTs, this I show to people who don't know. No? We know that there are like baseball cards. This is, for example, the one of Honus Wagner was sold for $6 million. And this one in Sotheby's is this CryptoPunk, which is digital and NFT, was sold for $11 million. And now there was one sold for $23 million a few days ago. So that's the analogy of art, no? It's like collectibles. And the best analogy is baseball cards. And a lot of people don't get it, but I get it. I think they're very valuable. When you buy an NFT, in the case of collectibles, this art on the internet, you have to be aware that the whole thing is not yours. When I bought an ETC Punk, for example, the producers of the ETC Punks, the 10,000 ETC Punks, they own the intellectual property of what I bought. What I own is the object, the collectible, the physical object that I have in my wallet. But the art itself is intellectual property that usually is retained by whoever created it. So what does the collector buy? And this is, for example, the clarifications of CryptoKitties, the first NFT in 2017. And here they have the rules. What can I do with my CryptoKitties art? And here it says you can buy it, you can sell it, you can hold it, transfer it, put it in your home, I don't know, in a picture or something. But these are the things that you cannot do. You cannot modify the art because it doesn't belong to you. Using the art to market or sell third-party products, like licensing the image, you cannot do it because the owner is not you, is the artist, and other things. So it's important to know this. The owners of art, just like in real art, do not own the intellectual property. They own just the piece. How to build an NFT? When I tell this to my clients who are corporate clients who are thinking of building NFTs for different use cases, so whichever is the use case, this is the general structure. I thank you to Patient Money and Savage Profits, because I consulted with them how and also the developer who built Classic Pharaohs. I consulted with them and they all confirmed this structure. So you connect You create a website where you show your NFTs. In the future, it's going to be a Web3 website, but today they're centralized websites. And in that website, usually you do the minting, transfers. Sometimes there's a market, and it's basically where you can do the display and sell your NFTs. And that website has to be connected to the traditional wallets like MetaMask, Trust Wallet, Coinbase Wallet, Wallet Connect, and I'm going to put here Hibi Wallet as well in the case of ETC. And then inside a blockchain, you have the ERC-721 contract, and that's going to be the backend. It's inside the blockchain. It's going to be the backend of the app. So here you see how one part of the app is external, which is the wallets. Another part of the app of the dApp is a website, and another part, the core logic that is important to keep secure, is inside the blockchain, but not everything. And then the object that is attached to the NFT is in IPFS through Piñata. You can use Filecoin also here. IPFS is a peer-to-peer network of nodes that they store these files. Piñata is an API service that you can do it easily. It's like a connection to the IPFS service. So you have the object is here, the metadata, and the object sometimes. The smart contract is in a blockchain, and the website is used for these functions. And then you have to be able, these things have to be able to connect to a blockchain. No? So in the case of ETC Punks, you do the minting here, it's done in a wallet, and the wallet connects to ETC to process the transactions that were originated here. And the transaction is going to be sent to the smart contract that changes the state, and it's going to change the ownership of whatever is here. So this is the structure, typical structure of an NFT service. In the future, these objects are going to be cars, homes, etc., and the websites are going to be very sophisticated. This is example code of an NFT backend code inside a blockchain. This was written by Open Zeppelin, which is a very important smart contract auditing firm. And let's see famous NFTs. So these are my 8 crypto kitties that I have in Ethereum. I bought them in 2017. This is the first case, most famous case. This is ETC Punks on Ethereum Classic. This is an example of a marketplace. Everybody puts their ETC Punks here, and they put an offer price, so you can see the offer price, and you can click on any one of these and buy it if you want. If you own this one, for example, then you are the owner. This is the link to this NFT. So it lives through Piñata Cloud. It lives inside IPFS, and this is the metadata of that unit, which is number 15. This is the ETC Punk number 15, and this is the metadata as seen inside the NFT contract inside Ethereum Classic. So here in this image, you can see how everything is connected from the website to IPFS to the metadata inside the NFT, inside ETC. And every transaction, every move that you make, it's going to invoke the wallet that you're using, and you sign the transaction, and it goes to the blockchain. In this case, ETC Punks chose also to show your balance and to show your NFTs. So you associate your MetaMask to the website, and you can see your NFTs. This is the case of the most valuable NFT ever sold. It's Beeple every day. It's the first 5,000 days. It's the most expensive NFT ever, nearly $70 million. And it's basically a collage of all the art of this artist. Myths versus reality about NFTs. So the myth, collectible NFTs are a new paradigm in art. That's a myth. Collectible NFTs are a good investment and will go up forever. That's another myth. I think everybody's going crazy buying NFTs for $23 million. NFTs will replace all modes of investment in the world. We're all crazy with the NFT fashion now. The reality is that NFTs are just a technology, just a blockchain technology that guarantees the uniqueness of digital objects, nothing more. Art is just art. and it's the same as before, whether you do it in a digital form or physical form, but the value of art is the same. Like art, there are things that are valuable and others that are trash. So many NFTs that are very valuable now, I think that they're going to be declared trash in the future, and they're not going to be valuable. So you have to be as careful as if you were buying real art with NFTs. It behaves the same way. And traditional art, baseball cards, real estate, etc., they remain unique objects in the real world, and they're still gonna have value. And I think that NFTs, the collectibles, are going to be just another form of investment in art. So this is the section about NFTs. Anybody has any questions about NFTs or comments or opinions?
I would argue that NFTs also have a dark side. It enables people to, I don't know, make corruption and launder money and other stuff like that.
Bueno, I think that in terms of what thing bad you can do is just take advantage of this wave and create some stupid trash, and then people send you 20,000 ether because they think it's valuable just because they're naive, and then it's you do a rug pull, or they're just worthless because it's bad art. But I don't know what you mean by corruption.
So let's say I want to bribe someone from the government so that I win a contract.
Ah, okay.
And all I need to do is make that responsible, make that government guy open or sell an NFT on the market,
Uh-huh.
and I go in and buy it, and he gets the money.
Ah,
I get
okay.
the tree, the picture with the tree, and
Yeah, yeah, yeah.
the contract goes on.
Yeah, that's a that's a very good idea for corruption. um, I think that it's actually done in real art as well, no?
Yes, I think so, because art is very subjective.
Yeah,
But we also need to think that real institutions are producing money, like museums, like I don't
yeah,
know, art galleries. You people are buying tickets and go there and read about the art there, and their money produced, and this is how culture is being sold.
yeah.
So NFTs are a bit different, in my opinion.
Yes, yes. Yeah, they're difficult because they live in blockchains and in the digital world. I think in that sense, maybe the market for art may change. It's great to see Sotheby's and Christie's selling NFTs because I mean they're very traditional entities and using the blockchain. That's amazing. Uh, um, one interesting thing is that I one of the things that I think that are going to be used for NFTs is hotel rooms. It's going to be an NFT. If you pay, your key is going to open the door and things like that. No? And when you leave, you just don't pay and it's deactivated. But that's also a source of corruption in Argentina, for example. The president of Argentina, Cristina Kirchner, who's now vice president, she owns many hotels. And what she does for corruption is when somebody wants to bribe her, she tells them to buy many rooms, to get many rooms in a hotel. So she launders the money through the hotel. So eventually that's going to be NFTs as well. Any other questions about NFTs?
Uh, just one thing that I want to comment about NFTs. Uh, this ownership of NFTs basically relies on a link.
Mhm.
So you don't store it on your hard disk or something like that. You don't own it in a physical way in your
Mhm.
computer. You own it. You own the link to it
Yeah.
or the address to it.
Yes, it's here. The thing is here. This is the link. This is the only thing that you have. Um, yeah, that is correct. Yeah, I think that the structure of NFT today is still pretty weak. Security is pretty weak. Um, Not all the NFTs have the stuff in IPFS. I don't think that IPFS is such a secure. It's very secure, but I don't know if it's that secure. Maybe with Filecoin it proves to be super secure in the future. But yes, these links, they're going to be made better in the future. I think, especially when they start linking cars and real assets. For now,
Yeah.
I would say it's a technology information. Um,
The combination with a file storage, decentralized one, would be wow. Like you would really add value and security
yeah,
to what NFTs want to be.
yeah, to close the loop and to make it really secure. Yeah, I'm sure this all is going to evolve very quickly. I think. Um, I was going. Bueno, what I explained to the NFTs is the basis for the rest of the cases because NFTs are an excellent example of how property in the blockchain is stored, um, controlled, moved, and traded. And the blockchain has a property title system, the property registry system, plus the money, plus the programmability. Everything is in the blockchain for those key functions. So we're going to see how that is relevant now in the other things. Ownership records and property registries on the blockchain. So like I said before, I think that cars are going to be represented as NFTs in a secure way when it's secure, no, inside blockchain. So you're gonna have ETC, and this car is going to be worth, I don't know, $18,000, and this car is going to be connected to its own NFT inside the blockchain. And then if you like it, you're gonna press buy, and it's going to invoke your wallet, and you're gonna pay, and this NFT is going to be transferred to your account, and now you are the owner of the account. Locally in the car, the car is going to see this transaction, and is going to know that the new owner and the private keys of that owner is the one that controls the car. Not only that, but um, car loans are going to be attached to this. So when I buy it, I just put 10%, and then somebody with it from their wallet, they're going to lend me the other 90%, and I'm going to pay from my wallet the loan to this guy. And if I stop paying, then the smart contract or that controls this NFT, or the code that controls it is going to automatically deactivate my private key until I pay. And eventually, if after many months I don't pay, it could even transfer the NFT back to the guy who lent me the money. So very complex things can happen using NFTs and smart contracts and money, everything inside the security of the blockchain, especially in blockchains like Ethereum Classic, which are proof of stake. So the blockchain is the property registry, as I said before. The same thing as I explained with cars, but with houses, they're going to be represented as an NFT. You're going to be able to get loans and be connected like the car loan as well. And you're going to be able to rent this house, for example. So you have everything activated. Houses are going to be intelligent in the future. So everything's going to be activated once you pay everything. And as long as you pay the rent or pay your mortgage payments, everything's going to be fine. And maybe after 10 months or 12 months of not paying, then the smart contracts are going to start restricting your use of the things. But very complex conditions and combinations of smart contracts and NFT are going to enable very cool services, I think, in the future. and accelerate automation of things in the future as well. Continuing with the theme of property registry, bueno, today company shares basically are a book that you get if it's a private company, and you write in the book who owns the shares and all that, and when somebody sells shares to somebody else, you just do the entry inside the book. In companies that are large, and that they trade in the stock exchange, for example, Apple, they use a computing service that is they're their registrar, and the whole $2 trillion of Apple shares are registered in this third party company that is a registrar that has their own private servers, and they keep the books for Apple. So whenever we buy and sell shares, this registrar is in charge of moving the shares from one owner to the other one. All that is going to be transferred to the blockchain. It's already digital. So if it's in book form, the books are going to disappear and people are going to do a smart contract. So it's going to be very likely like an ERC20 token, but instead of issuing some arbitrary token like Shiba coin, you're going to issue actually the shares of Apple. And on the blockchain, you're going to vote and do everything in the Apple company like normal. But the booking and the location of the shares and the payment of dividends and all those things are going to happen inside the blockchain eventually. And the blockchain is the property registry of companies, and the shareholders and even the stock market is going to be Uniswap, for example, or some kind of decentralized exchange where Apple is going to trade. The whole New York Stock Exchange is going to migrate to the blockchain. And then transfers. If you want to move shares without selling them, you just want to send them to a family member, something like that, you're going to do them there. And the firm, which is basically the organization, the company, is going to be the most owned and administered through the blockchain. Myth and reality. Bueno, this is important to distinguish. Possession and ownership are transferred 100% to the blockchain. And ownership records on the blockchain eliminate 100% of traditional systems. Well, this is a myth. I'm going to say why. With property records on the blockchain, there will be no more disputes. This is another myth. There's many idealists, especially in Ethereum, that they can do governance systems and everybody's going to live in peace and the blockchain solves all the problems of humanity. No, that's not going to happen. The reality is that the blockchain only enforces possession. Property is really, and possession are really two things. For example, the 3.6 million ETC that the DAO hacker has inside ETC, he has control of that. But legally, it's doubtful that any judge is going to say that he has property of that, legal property. The concept of property is an abstraction. The concept of possession is a physical reality. No? You have the private key, you have the public key, and you control it. And as long as you're recognized as the property owner, which is a legal thing, you are free to continue controlling that asset. But if you're not the legal owner because you stole it or something like that, you're still going to need the legal system to solve those problems. For example, the hacks. A few weeks ago, they caught the Bitcoin hackers of Bitfinex. No, they did it in 2016. So that legal process where you define that those guys are not the real owners and that the money has to be returned is all legal abstractions that occur in the social layer. The blockchain, the only thing that provides is control. But whether that control corresponds to the legal world is something that stays and will not change in the social layer. And disputes are going to continue to exist. So those were the myths that I wanted to separate the concepts and affirm that the legal system is still going to work. Maybe it's going to be modified. Maybe they start recognizing the blockchain as the property registry place, and they move them from the traditional ones. But the abstractions of the law that talk about property, possession, and when it's rented, the legal rights of the parties and all that is still going to be resolved in the legal systems. Continuing with the concept of property registries, it's a good segue to explain what is a DAO. Well, a DAO is basically a contract with rules, and participants can send their money there, and they can get tokens to represent their participation. And with that participation, they can purchase and sell their tokens, do transfers, they can vote, and they can decide stuff on this entity. A DAO means decentralized autonomous organization, and it doesn't mean anything else. It's not artificial intelligence or a robot that governs itself or something like that. It's just an entity, just like a firm, like a company, that has rules, and it can be used for many things. For example, the DAO was a mutual fund, and now we're trying to create a DAO in ETC to receive donations that are going to be directed to infrastructure and development of ETC. So they can be used, they're basically smart contracts with rules that are going to keep a treasury usually, and the rules are going to be in the smart contract, and based on those rules the participants can collectively make decisions. So it's called autonomous, I think, because it's inside the blockchain, and anything in the blockchain is autonomous because it's going to live there forever and nobody can change it, and governments and corporations, they cannot reverse that. But the reality is that they have this structure, and they're going to be used for investment, charity, loans, pensions. I designed a pension plan. It was called Ether Plan Pension Plan on Ethereum, business, etc. So this structure of the DAO is a general structure, and it's called autonomous simply just because it can continue operating indefinitely, as long as the participants have their tokens and their private keys, etc. And I put here the little images of MetaMask to show that every transaction you have to sign, and you have to pay for the transaction fee, and you're always going to have the interface on your side that is going to hold the private key, so you can have control of these things. Reality and myths. Let me see what's the time. Okay, we have 9 more minutes. The DAOs will replace all types of legal entities. The code and rules of DAOs is law, is the real law, and DAOs cannot be regulated. Those are all myths. The reality is that yes, I am sure that the firm and corporations are going to be moved from books and governments to the blockchain, but you still need the legal system, because the concept of the firm and limited liability and things like that are still legal abstractions. Those are going to stay in the social layer. The blockchain is just going to be the code and the automated mechanics of the rules of these entities. But whether you are the legal owner, you have real property, if you have rights, because you own the tokens, if you have limited liability, if there's disputes between the owners of a DAO or a corporation on the blockchain, if there's disputes even with clients and providers and all that continues in the legal system. So it's not a complete replacement. What it does is that the treasury and the code and the rules are in a trust minimized environment, and that's the critical part. But all disputes and legal considerations are going to continue to live in the social layer. So that's the connection between the social layer and the DAOs. Contracts on the blockchain. I'm going faster now because we don't have much time. So it's more or less the same concept. As you can see, the theme from the theme of NFTs and how they work to property and registries on the blockchain, to DAOs, to contracts and all that. It follows a logical line. No? If you think about it, the a company is basically, whether it's in a traditional system or on a blockchain, is basically a collection of contracts. No, a company is a firm, and it has agreements with their customers, and it has agreements with their providers, and it has agreements with their employees to pay them every month, and they have all those agreements somewhere. Sometimes they're verbal, sometimes they're physical in paper or digital form, and they have them somewhere. When I think that those all those agreements are going to be turned into smart contracts. So the firm is going to be a smart contract in itself, like I said before, shareholders, the market, all that. But the relationship between the firm and customers is also going to be a smart contract. For example, if the firm is a telecom company and somebody buys a prepaid phone, that prepaid phone is not going to connect to the private service of the firm anymore. I think it's going to be a smart contract on a blockchain. And as long as the customer pays on the blockchain to the smart contract the price and this smart contract is controlled by the firm, then the phone is going to work and use the network of the company. And everything is going to be paid with a wallet. No? So today, this agreement for that prepaid phone between the telecom company and the customer is somewhere in some cloud server. But in the future, that logic is going to be on the blockchain, and it's like a smart contract between a customer and the company. The same thing with employees. All our salaries and everything is going to be coded in our smart contracts. And when we quit, we just send the transaction to the smart contract that we quit, and the firm stops sending money. And we're going to do all these transactions and agreements using our wallets. And the same with providers. No, if there's an, I don't know, a provider of concrete that sells to the firm is a construction company. They send the concrete, and the contract, this smart contract is going to say, okay, when the trucker confirms in a transaction on the blockchain that it was delivered, then this smart contract is going to pay the provider. No, that's a simple rule of so everything is going to be contract, contract, contract. Why? It's not really going to replace anything. The contracts already exist in the real world. It's just that they're going to be transferred to the blockchain and coded into the blockchain. Gaming and the metaverse, it's very simple. I think that if this is the metaverse, I think that this car, which is a car in the metaverse, or this building that is a building in a blockchain that supports the metaverse, this is real estate, digital real estate, all are going to just work in a blockchain the same way that blockchains work in the real world. No? We're just going to use devices, 3D devices, etc., and the metaverse is going to enhance everything. But I think that the blockchain role is going to be exactly the same as in the real world. You're going to control your property and money and everything in the metaverse the same way that you control it outside the metaverse. So when you have a transaction inside the metaverse, some metaverse MetaMask is going to appear here, and you're going to have to press send in the metaverse. But in the back end, the blockchain is going to be the same one. I'm going to skip this because it's basically how to build a crypto app. So you have the front end, and you connect the banking system to crypto, and this is the front end. And you can construct everything yourself, which is very risky. This is what Coinbase does, and Binance, etc. They have everything proprietary. Or you can use a third party. You just have a booking system, and you have a third party like BitGo that they provide all the services to integrate crypto into your app. And finally, data science. Today, data science is basically you suck data from all your clients and what's happening in your business, and you put it in a data lake, and then you use machine learning and artificial intelligence to create data products and create recommendations and campaigns and advertising and all sorts of stuff. Well, the reality is that this is not going to change much. I don't think that this is going to migrate to the blockchain. I think that these things require so much computing power, big data, and so much data that I think they're going to stay in the cloud, in private clouds. And the only difference is that all the data from the blockchain, they're going to suck it into the data lake, and from there it's going to be processed by the algorithms and produce more intelligent outcomes. And perhaps these outcomes are going to enter transactions. The robots, the machines, are going to enter transactions into the blockchain. So this is my view of data science. So that's it. Congratulations to everybody for enduring. We have 2 minutes left. I don't know if anybody has any questions.
I just wanted to say thank you for the course.
Thank you, Jalen. Thank you for sticking these 2 hours.
It was pretty cool.
Thank you very much, bro, for organizing this and for recording it. And thank you very much, everybody, for listening to the course. Goodbye.